Yo, what up, everybody? This is your boy Sharaf again. Once again, I'm back with the Disruptive Investing channel, a channel focusing on investing in disruptive growth companies and technologies. I'll try to bring you my research to help you make your own sound investing decisions, but please do note that I'm not a financial advisor and this video is only for entertainment purposes. Today, I'll be walking you guys through three major investing lessons or mistakes that I've seen some beginner as well as intermediate investor make on their investor journey, and I'll share it with you guys to help you become a better investor in this crazy financial market. However, before I get into the meat of the video, let me first emphasize what this video is not about. This video does not cover the very basic investing principles such as don't panic sell, hold long term, don't buy stock without doing some due diligence and research, don't buy the hype, cut your losses, and let your winners run, and more importantly, don't blindly follow YouTubers. I'm assuming that the audience watching this video is already familiar with this basic investing fundamentals, so I don't think I'll be adding much value if I regurgitate the same concept over and over again. But if those concepts seem unfamiliar to you, I would suggest doing some basic research before investing any of your hard-earned money, especially in this crazy financial market. Well, with that being said, in this video, I will be outlining some subtle nuances and psychological factors that can help you become a better investor. So without any further delay, let's just get started. The very first topic that I would like to cover is that you should always read the financial numbers with some context. Unfortunately, relying exclusively on financial numbers is a bit of a trap for intermediate level investor, and it is a little sad as the intention by a new investor here is to do the right thing. As new investors graduate from blindly following the news and investing based on only on hype to finally looking into some financials such as PE ratio, PS ratio, or book value, etc., they sometimes end up going toward the other extreme end of this spectrum, which is to only look at one or two financial numbers in isolation and not understand the larger context, which is equally very important. This is how the scenario usually plays out. A new investor who, after being exposed to the financial market for some time, suddenly comes across the power and usefulness of the PE ratio and the level of insight it provides into the health of the company. But then this investor's vision becomes so narrow that he makes his investing decision solely based on the PE ratio without looking at other aspects of the company. A case in point, let's look at the example of Intel versus AMD stock. If this new investor just looks at the PE ratio of Intel and AMD stocks, which stands at 12 and 39 respectively, a less savvy investor might think Intel is a far superior stock. However, in reality, this is not exactly the case. A fact that is evident from the past 1 year return of both companies, where Intel stock price grew approximately by 7% compared to 32% for AMD. Again, this can be explained if one were to look at the growth of the company through its revenue growth. It can be seen that over past few years, especially in 2020, the growth of AMD was a lot higher than Intel, 45% compared to only 8% for Intel. The high growth rate also means that the AMD will be taking over the market share of Intel and thereby making it more profitable than Intel over a longer period of time. Therefore, the one big takeaway from this is that when you're looking to invest or comparing two companies, always factor in the growth of the company when looking at its PE ratio. One way to do this is by looking into PEG ratio, which incorporates the projected growth into the PE ratio by dividing PE ratio with the forecasted growth rate as shown in this formula. Another danger of looking only at the PE ratio is that it does not tell you anything about the debt of a company. Debt is a big burden on financial performance of any given company, and if you're only looking at PE ratio exclusively, then you will miss the debt factor which reflects a health of a company. Again, this also means that you're not having a fair comparison between a debt-free company and those bogged down with outstanding loans and liabilities. A case in point is Bombardier, which has a PE ratio of only 0.75. To a novice investor, this seems like a steal until one looks at the debt of this company, which stands around $8 billion, which is almost twice as much as its market cap. Therefore, a company like Bombardier can easily go bankrupt if it's not able to meet its debt and interest obligation, which are significant. I gave an example of PE ratio here, but again, the big issue is not just restricted to PE ratio, but also applies to other financial ratios and numbers as well. The point being that no single ratio can tell you all you need to know about a stock. You have to take a holistic view and take into account a variety of ratios and tools to get a fuller picture of financial performance and stock valuation, as well as any major news or change in the company's fundamentals. Well, the second topic that I would like to cover is taking the contrarian approach or contrarian investing strategy. Well, as the name implies, it is a strategy that involves going against the majority investor sentiment at a given time. So sometimes many investors try to act smart by going against the overall market sentiment, thinking that they are some kind of geniuses for taking this approach. While going against the grain of investor sentiment in itself is not an issue, but the issue arises when this approach is taken just for the sake of taking a contrarian approach without any kind of investment thesis or fundamental logic behind it. Guys, you really need to have a very strong conviction backed by actual facts before you take the contrarian view. It is not just sufficient to look at the market or equities chart and short the market or stock if it is at all-time highs or vice versa. That is just a recipe for disaster, and so many people have been burned that way. An example of this is when people started shorting Tesla stock while the stock was at all-time highs, gaining momentum throughout last year. And we all know how badly that ended up for so many people as the stock price kept going up and up and up. Sometimes, if a market or a stock consistently goes up or down, there's a good reason behind that, and blindly trying to call the top or bottom is just as good as gambling with odds stacked against you, which is the worst kind of gambling. Honestly, sometimes it is easier to follow the market and make money that way instead of trying to go against it. However, if you really want to go against the crowd, here are some common tips and tricks which you should follow. Do not short the stock as a contrarian strategy. I would highly recommend against shorting a stock on upward momentum. The risk to reward ratio is just not in your favor. There is no limit to the amount of money you can lose if you short the stock that is going up. It is just not worth it. Number two, understand the underlying fundamentals. Although this can be said about the overall market from a macroeconomics point of view, but in this case, I will be referring to individual stocks themselves. If you're buying a beaten down stock or selling the stock which has run up very quickly, please just don't take the buy or sell decision at the whim or purely on price action, but rather try to take the long term approach by understanding the fundamentals of the company, which includes looking at common metrics such as revenue, debt, sales, profit, etc., among many others. Lastly, do not use margin and have the nerves of steel. There is a famous quote which says the market can remain irrational longer than you can remain solvent. Sometimes your contrarian approach can be correct, but it may take a very long time to play out. And that's why my previous point of studying the fundamental is so important that you have a strong conviction. This also means that you should not use margin while taking the contrarian approach, as your positions can be closed out before your thesis even plays out. From my personal experience, a case in point is the Alibaba stock. I'm a long-term bullish investor on the stock, but the stock keeps testing my patience as it keeps dropping due to non-financial factors. However, since my bullish convictions are based on due diligence of the company, and since I haven't used any leverage on the stock, I can hold out for much longer time before the negativity surrounding the stock subsides and it can rediscover its inherent value. My last piece of advice is directed especially towards young investors. If you're someone approaching the retirement age, you may feel free to skip this topic as this may not apply to you completely. As most of you would know that all things are good only in moderation. So while it is not advisable to go all in on a meme stock or SPAC stock, but at the same time, in my humble opinion, it can be equally harmful to play it too safe in investing. And trust me when I say this, I say it with full responsibility. Take, for example, if you really want to play it completely safe, you can invest all your money in one of the safest form of investment, which is 10-year US Treasury bond. The interest offered on 10-year US Treasury bond is only 1.36% annually, whereas we have seen inflation rate upwards of 4% since April 2021. And even in the long term, around 2% inflation is considered acceptable by many. So the point is that in this scenario, if you invested your money in US Treasury bond, you'd be losing money due to inflation. This may be one extreme example, but the same idea applies with other investment strategies as well. For example, if you look at the 2020 chart for the market returns of the growth stocks versus value stocks, you can see that the growth stocks completely outperformed value stocks. And if you were among the people sitting on the extreme end of the safe value investing, you would have missed out on some big returns since 2014. Again, just to be perfectly clear, I'm not saying that you should only do risky investments or value investment does not have its place, but all I'm saying is that you need to have a more balanced approach to investing if you fall on the one extreme or the other. So, with that in mind, here are some of the tips and guidelines to follow if you would like to increase your risk appetite in a more responsible way. First of all, respect the growth. Growth commands a premium. It goes without saying, if you're increasing your risk appetite, you're expecting, or at least your objective should be, to have a proportionally higher reward in the form of higher than average return on investment. One of the most important metrics to look at in this regard is the growth of the company in terms of increasing year-over-year sales and revenues. The best example of this is Netflix stock over the past 10 years. You can see from the chart that Netflix has been growing revenue quarter over quarter and year over year since last 10 years. Anytime during this period, one could have sensibly argued that company is overpriced and is not worth investing. But if you had higher risk appetite, trusted its incredible growth, and accepted the fact that growth commands some premium, then you could have made some incredible return as the stock price has increased by more than 1500% in just last decade alone. Manage your risk. Nothing is certain. The second thing to understand that in life, especially in stock market, nothing is for certain. No one can predict the stock price or future with full certainty. There are only probabilities. If a high risk company can offer great returns, then on the flip side, it can have equally big downsides as well. I mean, for every Netflix or Tesla success story, there's always Theranos and Nikola as well. This is why not only you need to do your full research, but also take uncertainty into account by managing your risk. This means diversifying your portfolio within multiple industries and sectors, hedging your investment, and keeping some cash on the side in case of stock market crash. The last thing I would like to say is invest in at least one revolutionary game-changing technology on the cusp of changing our future. While this suggestion shouldn't come as a surprise, as the main theme of this channel is investing in disruptive technologies, it goes without saying that I'm a strong believer in investing in technologies that would disrupt the industry and aggressively replace the existing way of doing things. A prime example of such companies are Tesla, Square, CRISPR, among many other companies. I personally invest in multiple disruptive companies. However, you don't necessarily need to invest in multiple high growth disruptive companies, but I would suggest at least investing or in one or two such companies. So that pretty much concludes the video, and I hope you enjoyed the video and found some value in it. If you really like the video and you want me to keep making similar videos on similar topics and on growth stocks, please hit the like button and subscribe to this channel, and that would really encourage me to keep making similar videos in the future as well. And if I get enough like, I may even make part 2 of this series, as I feel like there are many other tips and tricks that can help out new investors. So thank you very much for watching the video again, and take care and good luck with your investing.